Most people guess when it comes to life insurance, and that guess is usually wrong. Either they're dangerously underinsured or they're throwing hundreds of dollars a month at a policy they barely need. We're talking about a decision that could mean the difference between your family keeping the house or losing it, your kids going to college or not, your spouse rebuilding or starting over from zero. Here's the uncomfortable truth. The life insurance industry has done a masterful job of making this feel so complicated that most people just sign whatever their HR department hands them and call it a day. That employer policy covering 1 times your salary sounds fine until you realize your mortgage alone is 4 times that number. So let's actually break this down by stage of life. Because a 22-year-old single renter and a 45-year-old parent of 3 with a mortgage have almost nothing in common when it comes to coverage needs. The math changes, the stakes change, and unfortunately most people never revisit the conversation once they've signed on the dotted line. When you're young and single with no dependents, the industry will still try to sell you a massive whole life policy because the commissions are delicious and you're easy to scare. The honest answer is that in your 20s, with no one relying on your income, a small term policy just enough to cover debts and final expenses is probably all you actually need. Then you get married, and suddenly the calculus shifts in a way most couples don't fully appreciate until it's too late. If your partner depends on your income in any meaningful way, you now need enough coverage to replace roughly 10 to 12 times your annual salary because grief is expensive, and so is rebuilding a financial life alone. Add kids to the picture, and we enter what financial planners call the maximum exposure years, which is a clinical way of saying this is when losing you would be the most catastrophic it will ever be. A common rule of thumb is 10 to 15 times your income, but factor in childcare costs, education, outstanding debt, and your partner's ability to re-enter the workforce, because the real number is often jaw-dropping. Here's where the historical irony kicks in. The people who need the most coverage, young parents with mortgages and kids, are also the ones who tend to buy the least because the premiums feel tight and the future feels distant. Meanwhile, people in their 60s with grown children and paid off homes are sitting on massive whole life policies they bought in their 30s and never reassessed. By your mid to late 40s, the math starts working in your favor. If you've been disciplined, your kids are older, your mortgage balance is lower, and your retirement savings are building. This is the inflection point where many financial advisors will tell you to honestly ask whether you still need that massive term policy or whether your assets are doing the heavy lifting now. A lot of people assume life insurance is purely about replacing income, but it also serves as an estate planning tool, a business continuity mechanism, and in some cases, a tax-advantaged savings vehicle, though that last one deserves a healthy dose of skepticism, because the fees embedded in many cash value products are quietly brutal. Understanding what job you're actually hiring the policy to do changes everything about how much you need and what type makes sense. The misconception that term insurance is throwing money away is one of the most financially damaging myths in personal finance, spread largely by people who profit from selling you something more expensive. Buying pure protection when your need is highest, then letting it expire when your need has diminished, is not a failure. It's the whole plan working exactly as intended. Practically speaking, the most actionable thing you can do right now is run a simple needs analysis. Add up your debts, multiply your annual income by 10, add anticipated future expenses like college and elder care, then subtract your existing assets and any existing coverage. That number, uncomfortable as it may be, is your gap. And closing it with a straightforward level term policy is one of the highest return financial moves available to a working adult. The deeper philosophical truth here is that life insurance isn't about you at all. It's a financial instrument you'll never personally benefit from, which is exactly why so many people procrastinate on it. Discipline means doing the unsexy, uncomfortable thing now so that the people you love aren't destroyed by a problem you had the power to solve for less than the cost of a streaming subscription. If your situation is well covered, great, review it every 3 to 5 years or after any major life event and move on with your life. And if you discover you have a massive gap, don't panic, just act. Because a simple online term quote takes about 4 minutes and the peace of mind is genuinely priceless. Whether you're thinking about protecting your family, planning your estate, or figuring out how life insurance fits into a broader financial strategy that includes real estate and investing, Check out our links in the description below. We can help you get started.